All right, guys, welcome to StockCharts TV. This is the JC show, the untitled JC show. And we've been doing this for about, I don't know, I guess 6 weeks or so. And basically what the deal is, when everybody came up to me and said, all right, JC, let's do a show on StockCharts. I was like, all right, I'm down. I've been using StockCharts for since I was in college. I was like, all right, I'm down. What are we going to do? I was like, all right, let's talk about, let's make it educational. So something that there's a good lesson. Then let's talk about the market, obviously, and then let's take some questions, right? That seemed kind of like a no-brainer to me in terms of sort of progression throughout the 29 minutes. So let's dive right into it. I guess the first lesson that I think that the lesson for today is sort of taking a deep breath and taking a step back and weighing the evidence, right? Because I know that a lot of people get caught up in the way things should be, right? Like, oh, that stock shouldn't be at that price. It should be lower or it should be higher. Or, that CEO is not allowed, it shouldn't be allowed to tweet that. He's moving markets. Or, Congresswoman shouldn't be allowed to trade stocks. Like, that shouldn't be allowed. And, I think that's where the mistake falls. Because I've noticed throughout my career how many people, I used to do it myself. I was guilty of it myself, and I would spend more time bitching about it than trying to profit from the circumstances. A lot of people are focusing a lot of energy, a lot of time and attention into the way things should be, as opposed to recognizing how they are, recognizing what's going on, regardless of whether you think it's right or not. That's just what it is. That's what's happening. The stock is trading where it is, regardless of whether or not you think it should be there. That guy is going to tweet that out, regardless of whether you think he should be allowed to or not, right? That's not your problem. That's not my problem. That's up to the regulators to decide whether that's right or not. So I think as investors anyway, I think it would behoove all of us to worry less about what should be happening or what shouldn't be happening and worry more about what actually is happening. Are more sectors and industry groups participating to the upside? Or are we seeing fewer and fewer participation? Are we seeing less and less of that participation? Is the advanced decline line making new highs, or is it rolling over? It's making new highs. Are more countries around the globe breaking out to new highs, or are we seeing fewer of them breaking out to new highs? We're seeing more. January 2018, risk peaked, volatility bottomed, and it was a shit show for years after that in most markets, right? The NASDAQ 100 was the exception to that rule. Look around the globe, most stocks, pretty much all of them, struggled since that early January 2018 peak in risk. So I would encourage you to go through the Russell 3000 and see how many stocks in the Russell 3000 are above those January 2018 highs. And we're actually seeing the most ever currently. Again, you might not agree that that's what should be happening, but that's what is happening. I was on TV the other day and I was like, I don't know what everybody's so angry about. The VIX is going to 40. Stock market's making new all-time highs. Like, what is going on? What are people so scared about? And the journalist, not a trader, obviously, just kind of sort of off the cuff was kind of just like, well, we're in the middle of a pandemic. Maybe that's what people are worried about. And that comes back to, yeah, sure, we're in the middle of a pandemic, but that's not a secret. Right? Like, it's not like we woke up this morning. It's like, hey, we're in the middle of a pandemic, right? No, we knew a year ago. And stocks priced that in accordingly, very quickly, if you remember, right? Which is great. For us anyway, because we were shorting stocks and buying bonds. So for us, it couldn't have been any better action. The fact that it happened so quick was great. Fantastic. Faster than we thought, right? And then the market priced in better times ahead, obviously. And here we are a year later making new all-time highs, in a lot of markets around the world, and a lot of stocks around the world, a lot of stocks here in the United States for sure. So I guess the lesson of the day today is worry less about what you think should be happening or what your morals or ethics tell you it should be like this. Like, nobody cares what you think. Nobody. You can scream and scream. Nobody's going to listen. Nobody cares. right? I've been there. I did plenty of bitching way back in the day. And no, guess what? Nobody cared. Nobody cared. Even if I was right. And even if things eventually changed one day, nobody cared at the time. So I have found it as an investor. Now, if you work in fintech and you're trying to develop tools to make things better, whatever it is, have a ball, go for it. I'm all for it. Let me know how I can help. Ping me. But as an investor, in terms of, okay, we have this amount of cash and we need to put it to work, regardless of what we think, we need to focus on what's actually happening. So that's how I look at that. And that is the lesson of the day. Okay, now let's get into the market. I thought that was a good lesson. You guys think that was a good lesson? I thought it was a good lesson. I wish somebody told me that a long time ago. All right, so StockCharts TV, let's do this. For you guys who are interested in the slides, today we're going to dive into taking advantage of those circumstances, which I'll be the first to tell you. I think it's a bunch of horseshit what's going on Wall Street, but I don't got a say in the matter, so all we can do is try to profit from the situation, and we're going to do that today. So if you're interested in the slides, make sure to email info@allstarcharts.com. Make sure to include the password, fade the sell side. We want to fade the sell side. So that's the password. And if you don't put the right password, you're going to get some, I give presentations around the world, you're going to get some deck about Malaysian palm oil futures, maybe. So make sure to include the password, which is fade the sell side, right? That's what we want to do. All right, so, JC, you're so bullish, right? You're so, you've been so complacent, right? I've been getting this whole I'm too bullish thing for 6 months now, maybe even longer. And the market keeps going higher, right? It's not so much that I am bullish or I'm a perma bear, a perma bull or a bull tard or all these things that people call me. I'm not any of those things, right? I have to recognize the trends in the markets. And, I want to come back to this slide because I've shown it in prior episodes of the JC show here on beautiful StockCharts TV. Shout out David Keller. So if the world was really coming to an end, right? And all these bears are going to be right, because there's a lot of bears out there, man. We're seeing the most amount of bears. Some of these polls, most amount of bears since before the election in the advisor sentiment poll, and then on the AAII, it ticked up a little bit, but we actually had more bears than bulls just a couple of weeks ago. So I mean, just an overwhelming amount of bears, considering the stock market's never been in a better position. So it's really, really fascinating sort of dynamic. Volatility is still very high. So, and if we have a little bit of time here at the end, we'll talk about that volatility situation because I'm kind of interested in it. So, if stocks are selling off hard, you're probably going to see at least a relative bid in bonds, right? Some sort of flight to safety, to fixed income, to that guaranteed, government-backed money, U.S. Treasury bonds. We're not seeing that. We're seeing new lows, right? New relative lows anyway, new absolute lows too, for that matter. Consumer staples, right? No matter what happens, no matter how bad the economy is, we're still going to smoke cigarettes and drink beers and brush our teeth and wash our dishes. That's not going to change. So you're going to see a relative bid in consumer staples if stocks are selling off. That's consistent with an environment that stocks are doing poorly. Gold's still making new relative lows also. Now, this was a special circumstance because gold can outperform and stocks can still do well in that environment, right? That is true. But I would argue, which is the point here, I would argue that if stocks are selling off, gold, bigger picture, is probably outperforming in that environment. Maybe not going up, but at least outperforming. Like 08, gold sucked in 08, but it sucked a lot less than stocks did, right? Which is my point here. So you'll probably see a relative bid in gold. And then Aussie yen continues to make new highs. So yen Aussie flips upside down, keeps making new lows. And this is interesting. I get asked a lot, JC, why Aussie yen? Well, first of all, it looks like the other ones. Most importantly, it looks exactly like the other ones. Notice how yen Aussie ripped in the first quarter, February, March, just as the others also ripped treasuries relative, staples relative, gold relative. So the most important thing here is that it looks exactly like the others and everything else is secondary. We can talk about the reasons if you want, Aussie dollar, it's more commodities oriented, global growth, China, blah, 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 right? It's the more risk on, if you will, of those currencies. And then yen would be more defensive. You're talking about a yen carry, unwind, shit's hitting the fan. You're going to get a bid in yen. You typically see that. So an Aussie yen cross is consistent with risk. Aussie yen making new highs, treasury bonds making new relative lows, staples making new relative lows, gold making new relative lows, all consistent with an environment that stocks are doing well. And as it turns out, stocks are actually doing very well. The advanced decline line is the highest level it has ever been in history. The NASDAQ advanced decline line also. We got the most amount of new 52-week highs in the NASDAQ this week, I think, ever. You guys might want to check my math. If not ever, like in a long time, but a lot. Which my point is, all of that is normal, right? With these defensive areas not catching a bid, there's less of a need to own a rock. There's less of a need to own paper that's not going to pay you any yield, basically, right? Now, if there was such a flight out of equities, that money would need a home, and it's going to find that home in rocks and yieldless paper, right? But in order to justify taking money out of equities to buy rocks and yieldless paper, like, you need a good reason, right? And the market hasn't given us that reason yet, which is my point here. If the market starts having reasons, you're going to see that. You're going to see these lines not continuing lower, right? Small caps have just been an absolute ripper. I just want to zoom out a little bit. This is technical analysis 101, folks. Resistance in 2007, obviously, with everything else. Resistance again in 2011 and 2012, and then we broke out in 2013. This was also when the S&P 500 broke out, if you recall. So this was a big-time breakout, and then we hit the next extension level. These are Fibonacci extension levels. If you guys are curious to learn more about Fibonacci, you can go to allstarcharts.com/Fibonacci, and I lay out exactly why we look at it, how we calculate the numbers, and everything like that. And just to be clear, these levels were outlined a decade ago, and the market just continues to respect them. It's not like this is hindsight bias Monday morning quarterback where I'm lining up levels. Like, this math goes back, forget Fibonacci, and the Italians love taking the credit for them, as they should. But the, Pingala, shout out Pingala, 200 BC, came up with this math, over, what is it, over 1,200 years before Leonardo, 1,400 years before Leonardo, something like that. They came to the same conclusion, the same math, with different problems. But needless to say, it's all over the universe. We see this again and again and again. We break out in the Russell small caps. We hit that first extension target near 117, go sideways for several years, then break out once again, literally stop at 169 in 2018. I remember this short very well, as a matter of fact. For you guys who have been around for a while, you remember this too. First week of October, sell the hell out of Russell 2000. Boy, did that work out well. So fast forward a couple of years later, we fail at the same place. I remember this short, obviously, very well also, because it was more recent, but both at the same level for the same reasons. And it all goes back to Fibonacci. Well, a few months ago, we broke out back above those levels. So, it would be pretty idiotic of me to just ignore that next level near 252. It would be irresponsible. I think that's where we're going. That's where I felt we're going. There's some levels where we can find trouble in between here and there for sure. But that seems like the next logical level, and we want to be buyers of pullbacks in the meantime. And one interesting thing, shout out Ralph Acampora, he always told me, JC, sector rotation is the lifeblood of a bull market. And how about these energy stocks, small cap energy, breaking out to new 52-week highs? Or, maybe not 52-week highs, maybe 40-something week highs. But needless to say, soon there'll be 52-week highs as the calendar shifts over. Needless to say, new recovery highs, which is my point here, and on a relative basis, breaking out as well. This is small cap energy. Just think about that. How bad could things be if small cap energy is doing as well as it's doing, right? Think about that. Classic safe havens, Philippines and Italian equities, right? When money's scared, it hides out in Filipino stocks, doesn't it? And Italian bank stocks? No. They're buying this stuff. Right? New recovery highs across the board. Italian stocks making new recovery highs. How bad could things be? Seriously. Like, how bad could things be? All right, so let's talk about Pinterest. Let's talk about some individual names. I like this breakout here in Pinterest. This has been one of our biggest winners. I mean, wow. What a home run this was for us last year. And it has consolidated nicely sideways and now breaks out again. So $80 is my level there. If we're above $80 in Pinterest, I think we need to own it, and we're right there. I think the risk versus reward is favorable here. Certainly in favor of the bulls, for sure. Because if we're not above 80, then it's not our problem; it's somebody else's problem, right? So we know that that's the level. So if we're not above 80, then there's no justification for being bullish. Quite the opposite, actually. It increases the risk to the downside, increases opportunity cost, and there's those Fibonacci levels coming into play again and again and again. So, with Fibonacci, you can make fun of me. JC, Fibonacci, Liberace. Fine. You can ignore them all you want. So here we're looking at financials. So people are like, well, JC, the stock market's in a bubble. The bubble's going to burst any minute now. Any minute, JC. You're so complacent, JC. The stock market's the bubble's going to burst. You'll see. You'll see, JC, right? Those are the things they tell me. You know what they also tell you, and kids, for you guys paying attention, adults, like real adults, like actually intelligent, educated, experienced adults are going to look at you in the eye and they're going to lie to you. And they're going to tell you that it is just one giant coincidence that every time the U.S. Financials Index gets to this level, it sells off every single time. 1, 2, 3, 4, 5. They're going to tell you every single time it gets here, it sells off. And that's just by chance. That's what they're going to tell you. Can you believe the nerve of some of these people to lie to these poor kids, these professors? Your parents are paying all this money to put you in this school, and the professors are telling you this is just by coincidence, and they're teaching you the efficient market hypothesis? Makes me sick. But you don't have to take it anymore. We're not gonna take it, right? Oh, we ain't gonna take, right? You guys know the song. And kids, if you don't know the song, you think I'm crazy, look it up. But you older folks, you know what I'm talking about. You don't have to take it anymore. The revolution is upon us, right? The revolution will not be televised. You don't have to listen to this crap anymore. This is just common sense. You don't need JC to tell you this. You can just see every time financials get to this level, they sell off. And by the way, for you Fibonacci aficionados, if you take the high in financials earlier this century down to the lows after that first correction, where financials have been selling off every single time for the last 14 years has been at the 161.8% extension of that decline. Again, the professors will tell you that is just a coincidence. But I think for you guys that have been following along for some time, know that it is not. That's just the way markets work. Again, whether you like it or not, you might not like it, but that's just the way it is, right? You don't have to like it. So, great. What does this mean? Well, if they're telling me that we're in a bubble and that the stock market I'm too complacent and all this stuff, right? The U.S. Financials Index is arguably the most important stock market index in the world, or at least in the conversation. We can agree, maybe it's not the most important, but it's in the conversation. So if that's the case, and we haven't gone anywhere in 14 years, it's hard for me to swallow this bubble stuff, right? How are you going to tell me that we're in a bubble? I don't see it. So I think we break out, because I also learned the hard way, as we learned all the best lessons, is that the more times a level is tested, the higher the likelihood that it breaks. And by my count, we're going on 5-6 tests now. The higher the likelihood it breaks, right? So I think a breakout is coming. If we're above 31, which we currently are, it's hard to make a bearish bet. It's hard to make a bearish bet. And even if we're not above 31, any correction that we might get, let's say this is another whipsaw. Let's say there's another failed breakout or another, failed attempt to break through resistance, however you want to label it. Fine. I think it's going to be a shallow drawdown. I really do. Because the bulls are getting antsier and antsier and antsier. There's less and less supply up there for demand to absorb. Now, once we break through 31, you see a 32 handle, like we're out of this base. That is the market signaling that demand, finally, after 14 years of the financial crisis, finally, demand has been able to absorb all of this supply. Demand now overwhelms any supply there is for financials at these levels, and now we can all move on. I'll add another thing for you, and then we're probably heading towards 38. Just think about another 20-25% move higher in financials. Think about the implications of that globally. Are interest rates probably going higher in that environment or lower? I'd argue higher. That means lower bonds. Think about the international exposure to these bank stocks. Think Canada, think Europe. Huge exposure to financials. Think about, freaking Deutsche Bank making new 52-week highs. Like, think about that. Like, how bad could the world be if all those things are happening? I'll take it one step further. Many of you might not be aware, but Berkshire Hathaway is actually the largest component of the financials index. It's like 15%, 16%, something like that. It's the biggest component. So you're able to get the largest component of financials, super high correlation. Then you're getting some exposure into industrials and things like that. Obviously, a little Dairy Queen sprinkled in there, See what I did there? Sprinkled in there. So I think there's a lot going on in this chart from a lessons to from a historic standpoint to zoom out and see what's happened over the last couple of decades. I think it's really important. And then from an execution standpoint, that's my alarm so I don't go over, because I've been going over and they don't like it when I go over. So I'm gonna keep this brief, and we're gonna finish this on time. And then one more chart that I just wanted to show off is Chinese technology. This has been a monster for us. Chinese tech and Chinese internet was making new relative highs in the middle of during the worst part of the pandemic crash, like in late March, early April, something like that. Check, go back and check. But we were already getting relative breakouts in Chinese internet and Chinese technology in the depths of the crash, which was really, really telling. Like it's obvious now in hindsight, being like, oh yeah, there was wisdom and relative strength. But I vividly remember, and you can go back to the conference calls, you premium members of StockCharts, go back to the conference calls. I remember being like, that's kind of weird, right? Like the world is crashing, our bonds are doing great, our shorts are crushing it, like everything's fantastic. But why is Chinese internet making new relative highs? Like that doesn't fit in that puzzle. And I remember being puzzled about the situation. And needless to say, as usual, there was wisdom in relative strength. And needless to say, in case you kind of hadn't figured that out, I still like Chinese internet. Go to CQQQ, go look at the components. You'll find some good ideas. Go to KWEB, KWEB is another ETF. Go look at the components. There's some interesting stocks that trade over the counter. These are ADRs that aren't on the big exchanges, but they're over the counter. These are like $50, $100 billion companies. So there's liquidity there. So check that out. Okay. All right. So this is an interesting scan that we just dropped this morning. Everybody's always these days everybody's like, oh, they want to screw over the suits. We're gonna get them, JC. We're gonna screw over the suits, and they think that they're screwing over suits by being recklessly long AMC and GME and all of these, and BlackBerry, and like these idiots think that they're screwing over the suits by trading recklessly. No. That's not how this works. No. If you want to screw over the suits, you could do so intelligently and for good reasons, not just for, you think hedge funds are bad and you want to screw them over. Like that's the dumbest thing I've ever heard. Like if you think that, you're an idiot, right? Like they're very nice, great portfolio managers that I know and that I'm friends with, and I know their families. Like there are very good people in the hedge fund space. Like, so just to oh, I hate hedge funds. Like, you're an idiot, first of all. Second of all, there are ways to actually, quote unquote, screw over the suits, which my interpretation of screwing over the suits is sort of finding the inefficiencies in Wall Street, finding the conflicts of interest that exist in Wall Street. Maybe you don't like the fact that those conflicts exist. Maybe you don't, that's not the way it should be, and it probably shouldn't, but it is, right? And a great one is the sell side, because sell side analysts have a worse herd mentality than your average investors. Because there's career risk, right? Because if there are 20 analysts and 20 firms covering this stock XYZ, and 19 of those analysts have buy recommendations on it, and you're the one guy or the one gal that wants to put a sell on it, you better be right. You better be right, because if you're not, and you're the only loser that doesn't have a buy recommendation on this stock that's ripping through, and the other 19 analysts do, you're going to be looking for a job soon. And the way it works is these sell-side analysts have been overpaid for a long, long time, like really overpaid. You should see some of these salaries. I mean, maybe not anymore. They've been falling, but at one point it was hilarious, right? So they're used to nice vacations, kids in private schools, hefty mortgage, wife doesn't work, a couple of nice cars, probably picking up a third one for the teenager. I mean, serious expenses, serious lifestyle. So if you're going to go out on the limb, is it worth it for you to risk all of that? So little Chad won't be able to go to the same private school with all his friends and start the 7th grade, right? Like those are the things that analysts think about. And those are real conflicts of interest. And those are real human emotions. Like it's hard to fault them. It's not their fault that they think that way. It makes sense. Of course, you're going to put your family over the business, right? But fortunately for us, we recognize those conflicts of interest. We recognize that those flaws exist, and it's up to us to take advantage of it. So we're looking for the stocks whose prices are the furthest away from the average sell side target, right? So the ones that they're most wrong on. So you're essentially creating a short squeeze among the analysts, because when it's gone too far, then they have to, raise their estimates. It's the most ridiculous thing. You see these people with their like models, like fundamental models, trying to value these like growth companies. Like it's hilarious. Like it's so funny, but they have to at least pretend that they're doing that so they can justify their job. So little Timmy or little Chad can go to private school, right? That's the way it works. So we're looking for the biggest spreads ever. We create a universe in the same way that the Under the Hood report creates a universe of stocks that are showing an unusual increase in investor interest. The 2 to 100 club are stocks that we think are the next $100 billion companies that fit within specific industry groups, right? So we create these universes, and then we overlay our technical analysis to find the best risk versus reward opportunities on either the long side or the short side, depending. In this particular case, stock market's in a bull market. These analysts have it very wrong. They've been wrong. It's getting worse. And we're essentially squeezing these analysts out of their bad behavior, right? Not so much bad behavior, but like their bad analysis, their bad interpretation of the market, right? So a few interesting ideas here before I run. Here's Novacure. So let me just punch this up. Novacure. So we're talking about NVCR, Novacure. And this one is an oncology biotech. Develops treatments for various cancers. That's cool. And the average analyst has a hold rating and a target of 150. Meanwhile, the stock is around 180. So if the stock is above 178, we want to be long with a target of 250. So the stock's already pushing, 190 almost, and the average analyst has a target of 150 with a hold, whatever that is. The best is when they downgrade it from a buy to a hold. It's like, what does that mean? Am I buying the damn thing or am I not? All right, another one, Bloom Energy. This is a good one. This is a mid-cap industrial renewable energy and supplies for on-site power generation for the residential and commercial real estate markets. That's a mouthful. Average analyst target is 27.5, which is hilarious because we're 50% higher than that. So we are betting on a squeeze. If BE Bloom Energy is above 38, we want to be long with a target of 60. 60, we think that's next. And then finally, Redfin. Redfin's been consolidating nicely. This one is very similar to Zillow, is my understanding. And we are prices are the average analyst estimate is 40% beneath current prices. So if the stock RDFN is above 82, we want to be long with a price target of 110. If you're interested in the slides, sorry we didn't get into any questions. But I think I answered some of the questions in the early lesson. I don't want to go over my 29-minute mark. See, Gretchen, I see you. All right, so password, fade the sell side, info@allstarcharts.com. If you're interested in the slides, password, fade the sell side. Thanks, guys.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.